7:39, top-end consumer news this morning. The Federal Reserve seemingly poised to increase interest rates at their next meeting. That's coming up in March, and it could be the first of 3 or even 4 hikes that's coming in 2022. Here to discuss what this could mean for your wallet, we have financial expert Dan White. Good morning. It's nice to see you.
Good morning, Shelley. How are you doing?
I'm grateful to talk with you about this because you're going to make it easy for us to understand exactly what this means, because when we hear interest rates are going up, it doesn't sound like a good thing. Could it possibly be? What is the most immediate impact average Americans are going to feel if the Fed raises these interest rates?
Well, I think the immediate impact is you're going to see higher debt costs across the board. You know, a lot of people out there have home equity lines of credit, and these are not fixed rates. They're usually variable rates. So as the Fed increases interest rates, your home equity lines of credit are going to be higher, and your monthly payments are going to be higher as well. That's also going to be true with any type of purchases that you make, cars and even your homes. You're going to see mortgage rates go up. You're going to see car loan rates go up. So if you're trying to buy a car or a home, you might want to look into that sooner rather than later before they start hiking rates.
Okay, it might be hard to see this, but are there any benefits to a rate hike? Could anyone benefit?
There is. I think senior citizens are going to be happy about a rate hike, because when they raise rates, you're going to start to see a trickle up effect with bank savings accounts, perhaps CD rates, fixed annuity rates might go up. So people who are risk averse, those later on in life that don't really want to take risk in the stock market, they're going to be happy that short-term rates are starting to increase. We see a lot of people, I have money in the bank, I'm not earning anything, and where do I put it? And they don't necessarily want to take risk at this stage of their life. And I tell them to kind of sit tight. You might see higher interest rates in the near future.
Okay. And just briefly explain why they're doing this and why the multiple ones, not just one, but 3 or 4. Yeah,
the problem that we've seen in the last 6 to 12 months is, as you say, it's inflation. We know there's higher prices all across the board, and this is a direct impact of some of the Fed's actions in the past year. I mean, when COVID hit, they basically printed and dropped from the sky about $6 trillion in stimulus payments of some way, shape, or form. All that money needed someplace to go, and inflation spiked. And they said it was going to be transitory. They thought once they dialed back stimulus, this would disappear. Now they've kind of retired transitory from the vocabulary. They're saying, hey, it might be here for a while. And the way they fight inflation is tightening the money supply. So as they raise rates, they're hoping that inflation comes down. But with every action, you're going to have reactions. And that's kind of what we talked about, some of the reactions that we're looking at.
All right. Dan White, thanks for explaining that to us. Nice to see you.
Nice to see you as well.